So dental practice acquisition. Here's where we're going to talk about what you need to know when you're buying a dental practice. So when you're about to purchase a dental practice, what are you really buying? Well, number one, you're buying the physical assets. And what do we mean by that? You're buying the dental chair, the dental instruments, you may be buying some of the dental supplies. If you have some x-ray machines, you're buying the machinery, the computers. All those are physical assets, things we could touch. You're also going to be buying what's called a leasehold improvement. So you renovated a space, you made it a state-of-the-art office, you're selling those physical assets. Those all get a certain treatment depending on the type of assets they are. But the majority of what you're purchasing when you buy a dental practice is what's called goodwill. And what is goodwill? Goodwill is an intangible asset. We can't touch it, we can't taste it, we can't smell it, but it's there. Basically, that's the name and reputation of the practice. It's basically the phone number to the practice. It's the patient charts. All those things, put them together, that's the practice goodwill. So when you buy goodwill from someone that already has an established practice, you get to write off the purchase of that goodwill, but you write it off slowly over a 15-year period. But it's a tax deduction. So assuming you paid, let's say $150,000 for goodwill, you're going to basically get a $10,000 deduction every year for a 15-year period for the use of that goodwill. Important to know. On the sales side of it, if you're the dentist selling the practice, you have to make sure you call it personal goodwill. If you don't call it personal goodwill, and I get into this in depth in the article I wrote, if it's not called personal goodwill, then that goodwill, if you're in a C corporation, could be subject to double taxation. Even if you're in an S corporation or a general partnership, it'll still be subject to New York City corporate tax or New York City unincorporated tax, assuming you live and operate within the 5 boroughs of New York City. So you literally want to have 2 separate contracts, one where you're selling the physical assets to the buyer of your practice, and another one where you're selling your personal goodwill. So the wording and how you go about doing that and the steps you need to follow, I outlined that all in that orthodontic article that I wrote. There's covenants not to compete, that's non-compete clauses. Then you have leasehold improvements. What are we talking about leasehold improvements? Again, you're buying a practice, the guy before you spent $500,000 on renovating the office. He's now selling those renovations to you for $200,000. You get to write that off over 39 years. Same is true for capital improvements. There's another category, which I'm going to go in more detail in the following slides, qualified improvement property, et cetera, et cetera. At the bottom end of this, we have furniture, we have equipment, we have dental equipment. All that gets certain special treatment, and I'm going to go through this with you now. And by the way, when you do draft up that contract to purchase a dental practice or sell the dental practice, the big question is, how much should I allocate to each of these assets? And that's going to be a question that we would have to study together to figure out what would be most advantageous to you. So for example, in New York State and City, if you're selling your office equipment to a dentist and supplies, that's also going to be subject to sales tax to whoever's buying that. So we got to weigh out those type of things to the depreciation, et cetera, et cetera. So not going to harp on that too much, but it's an important decision that needs to be made. Okay, so has anybody ever heard of a cost segregation study? Okay, so if you own a practice and or you own the building with it and you bought it many years ago, you could get what's done a cost segregation study by an architect. Now, what does this cost segregation study do? It basically will let the architect come back. Yes, you paid $2.5 million for that building. When you buy a building, you have to depreciate it over a 39-year period. That's an awful long time. By getting a cost segregation study, the architect will prepare a study for you and will break down the components of that building into subcategories. So for example, if some of it was for heating and air conditioning, you may be able to write it off fully in the current year or take it over a 5 or 6 or 7 year period. So it gives you an opportunity to not spread out the purchase of that building over 39 years, but spread it, most of it out over a shorter period of time. And a tax deduction today is worth a lot more than a tax deduction 20, 30, 40 years down the road. So I very rarely have clients that do these cost segregation studies. Instead, what I tell them to do to save themselves a lot of hard work and effort, when you're doing the build out of your practice, let your architect as well as your contractor give you a detailed invoice. Don't let that invoice just say, Dr. Smith, $500,000, I'll have you in your office, all said and done. Get a detailed breakdown that breaks everything up into all of these subcategories. And then what we'll be able to do is, without a cost segregation study, we'll be able to get more depreciation in the early years for you rather than spreading it over many, many years. These are things that unless you're engaged in a meaningful conversation with your tax advisor, it's never going to come up. And that's unfortunate. If you're the type of person that doesn't listen to their advisor and just goes through the motions and at the last minute says, here are my bank statements, take care of it, and then the accountant or investment advisor, financial advisor, whoever it might be, doesn't come back and ask you 100 questions, that means you're leaving money on the table, right? You need to invest the time and energy in going through these questions, because if you're not, you're paying literally, if not tens of thousands, it could be hundreds of thousands of dollars on the table in unnecessary taxes.